Good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, September the 4th, 2025, recording this in the morning, just before the Challenger job cuts numbers. Talking of data, guys, let's have a quick look and see what's going on. Quite a lot going on. As I say, we've got the Challenger job cuts coming up in about 30 seconds. But before we look at that, basically the market yesterday, there is a bit of a sentiment happening that the labor market in the US is starting to show signs of a slowdown, some cracks in the data. And that was basically sort of confirmed or sort of, underlined yesterday by the JOLTS number, which came down significantly. So you see here that the number of jobs openings, it had been expected about 7.38 million, came in at about 7.18 million. So that was significantly down. And then we also saw that the layoffs level, that was really the problem. So you see here that last month it was about 1.6 million and actually jumped well above consensus to about 1.8 million. So that's 200,000 more layoffs which were recorded. So this whole sort of narrative that maybe there aren't a lot of not much hiring going on, but also a lot of people are not being laid off or fired. That maybe seems to be cracking a little bit. I mean, we have to get more confirmation of the data, but certainly that seems to be pointing to a softening labor market. The other thing as well is that the quits level, is nothing sort of special, and so that argues for the fact that wage rises should remain relatively contained, because if people aren't quitting that much, it means that there's not a huge amount of sort of necessity to hike in wages, and so definitely a bit of sort of softness coming in there. And what we have today, well, let's just have a quick look because we just got did we just get the Challenger numbers? Yeah. So here we go here. So US Challenger job cuts rise 13.3%. So that just came out at 7:30 now. So that looks as though that's not great news. More job. Let's have a look here. So 13.3 sets job cuts. So that looks as though there's more job cuts as well. Just this new data from Challenger. So again, a weakening labor market seems to be what's starting to show up in the data. Now we're going to have a lot more information as well. So if we start looking at what we've got today, so we just had the Challenger number literally released about a minute ago. That doesn't look great. We have the ADP number. Now that's the consensus is to come in at 68,000, down from 104,000. And keep in mind that the market often said, oh, this is not super correlated to the non-farm payrolls. It's a waste of time. But actually what's happened is that with those very big revisions, which we saw for the last 2 months, which shocked the market a few weeks ago, actually it turns out that ADP was a little bit more accurate than maybe at first blush. So the point is that the market will be looking at this. And also, as I think I mentioned yesterday, the fact that Trump has replaced the head of the Bureau of Labor Statistics, the BLS, there is, maybe a little bit of skepticism about, government numbers, and therefore any private surveys or private numbers may be given a little bit more respect and attention than has been the habit in the past. So ADP, again, look at this number coming in at 68,000 is the survey. Let's see how it turns out. Again, that is weakening and definitely a softening number. In terms of other sort of data and everything, I forgot to mention that yesterday we had the beige book. Now the beige book from the Fed is all of the districts of the Fed, all the regional Feds, a kind of a snapshot of what's happening in the US economy. And it does seem that there is some, a little bit of inflationary pressure, but what a lot of the participants or local businesses were reporting was kind of a flattening of business activity. So not necessarily business activity sort of collapsing or disastrous, but not really a lot of confidence. So it does seem to be a little bit of flattening there. So a little bit of negativity in the beige book as well. So we get the ADP at 8:15, and then shortly after, in about an hour, we get initial jobless claims. Now, what I've been saying for many, many, many weeks is that if it does come in at 230,000, that is still a very good number. It's still the 4-week moving average is still 220, 225, 230,000. That does not indicate a labor market which is collapsing. So as I said, there are some indications that things are worsening, but I personally would really want to see that that number appearing in the initial jobless claims. That should go up. So I'm going to be very curious to see whether that, sort of stays stable or maybe ticks up to 235, 240, something like that. We shall see. Then, of course, the other thing is continuing claims. The consensus is for 1.95 million. Again, what seems to be happening is that, people are, the labor market in terms of hiring and firing is relatively stable, although as we just saw from the Challenger numbers and what we saw from Jolts, maybe that's starting to turn. But in general, that's been the case. But what people have been saying is that the continuing claims is starting to get higher and a little bit longer. It's harder to find a new job if one does leave a job or one is fired, and that could indicate a softening market and a reluctance of employers to take on new people. So a lot of important stuff. And then we also have the ISM services coming up. And of course, we know that services represents, about 70% of the US economy. So it's going to be very important, especially the employment sector here. So again, consensus is for 46.7. So obviously below 50. Remember that anything below 50 indicates a worsening of conditions, a contraction in confidence, or in a certain sense in forecast. Your forecast level is going down. But on the other hand, also interesting to look at all the other numbers. Prices paid still very elevated. This is a problem? But it does seem, as I was pointing out yesterday, that the market now is seeming to think that the Fed is, in a de facto way anyway, sort of looking that maybe 2.5 or 3% inflation is not the end of the world, and they need to be worrying about their employment mandate a little bit more. So I'm not sure how important the prices paid will be for this particular market reaction. Also, new orders, of course, forward looking. So plenty of interesting data over the next couple of hours before we get the big one tomorrow, the non-farm payrolls. So let's keep an eye looking and all of those. And of course, that's going to be. Sorry, let's just go and have a look before I get out of the Bloomberg here. So let's have a look. That, of course, is going to be incorporated into how the market is thinking about the Fed. So as you can see here, for the September meeting, that's gone up even a little bit more. Remember, I think yesterday it was 22 basis points. We're now 24.3, so almost a full 25. As you can say, 97.2% the market is pricing in of a cut in September. So it looks like a done deal. And that's what I'm trying to say is that what would it take now for the market to price a rate cut, like to not price a rate cut for September? It would have to be literally all of this data plus tomorrow, plus the inflation data we're getting next week. Very, 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 very hot to do that. I mean, it could reduce it a little bit, a few basis points. So I think it's a little bit asymmetrical in this point that, let's say, a very cold set of data this morning combined with tomorrow, we could start to see this number of basis points go above 25, maybe even pricing in 1.5 cuts or something for September. And by the end of the year, December, as you can see here, gone up to 2.3 cuts priced in, so about almost 58 basis points. So the market is, essentially, if we look at the tick chart for December pricing, as you can see, pretty steady here, about 59 basis points, basically saying, the Fed's going to cut once or twice this year. And if things get really bad, maybe even 3 times. So for a total, somewhere between 50 and 75 basis points of cuts. So that's anchoring the front end of the curve. And of course, what markets are quite interested in is also the long end of the curve, because there is this, pretty much consensus at the moment that there's too much deficit spending, there's too much bond issuance, inflation does remain a little bit sticky. There's like a lot of sort of need for infrastructure spending. There's a lot of need for defense spending, especially over in Europe. And all of this stuff is putting pressure on the long end of the curve, putting up those sort of yields on the long end of the curve, so causing a steepener. So let's see if the steepening action continues. A couple of other things to look at, just while I've got it up here. We have oil here. Saying yesterday, see, oil continues to trade on the heavy side here. That's no surprise because, as I think I mentioned yesterday, there's been rumors going around that OPEC Plus at their meeting this Sunday will actually increase production. And of course that is technically that's not great for the oil market in a climate of uncertainty for global economic growth. And so you see here that oil WTI is trading a little bit heavy. It couldn't get above the 50 and the 100-day EMAs here, and it looks as though it could just test down to about 61.80 in the short term. Of course, on the other side of that is we did get some comments yesterday from sort of Energy Minister, Deputy Prime Minister Novak out of Russia, essentially saying that he didn't see any need to hike production. So, maybe it's not a done deal yet. And who knows if OPEC Plus, let's say this drifts down a little bit to, $62 or so, and OPEC Plus over the weekend decides not to increase their output, we could get a nice little relief rally back up to the $65, $66 mark, let's say on Sunday night going onto Monday. We shall see what happens. Other thing today, we do have Fed's Williams speaking at lunchtime. I think it's about 12:05 from memory. And it's going to be interesting because historically, Williams has been pretty close to Powell. So it'll be interesting whether Williams comes out. We have had, I would say, quite a lot of dovish neutral to dovish Fed speak over the last 2 or 3 days. Most of the speakers are saying, "Oh, it looks as though things are weakening. We have to be careful about the two-sided risks." Blah blah blah. Essentially, kind of preparing the market for a probable rate cut in September. So I think Williams today be interesting if he wants to push back on that in any shape or form. He's normally quite interesting from a technical perspective. He often talks about, what he regards as the neutral rate and how he calculates that. So that's definitely worth looking out for, 10 or 15 minutes at about 12 o'clock, just to see if he sort of confirms a little bit that we are getting, in fact, a rate cut in September, because he does seem to have the ear of Mr. Powell. So that's something to be interested to look out for. Other stuff we just had as well. There's been a lot of concern, which I've flagged and been looking at like everyone else in the French bond space. As you can see here, it's picked up in the last couple of trading sessions. So, I mean, this is almost we're not out of the woods yet, because we do have the confidence vote coming up on the 8th, which I believe is Monday, September the 8th. And you can see here that the French bonds have bounced, although one could argue that this is some kind of sort of reactive bounce from a sort of a technical level down here. So I'm just going to put that up here, and as you can see that is pretty much some support there. So it has come down a lot. So let's not assume that suddenly the French bonds are going to rip higher, because they still are under pressure. Having said that, what I would say is that we did have an auction this morning about I think it's 5:30 this morning, and I just read through the metrics. Relatively solid. So the market is quite liking that. So still a little bit of demand around for French paper, and we see this little bounce here. But I think probably we're going into today and into Friday over the weekend. Let's see what happens. But if Bayrou's government does fall, and there does seem to be a little bit of chaos and no valid sort of alternative on Monday, I think it's not at all impossible that we see French bonds heading back down towards this level here at about 120.50, and maybe even wanting to break those. And of course, that could put more pressure on the spread. So if you look at the French German spread here, you see that it's been elevated up to around the 80 basis points level. Obviously, in the last couple of days, that's come back down a little bit. But again, if we do get some sort of chaos and paralysis in the French political situation in the short term, as I say, next Monday, Tuesday, I think this spread here could definitely maybe break to new highs, even into the mid 80s or something, which presumably might start putting a bit of pressure on the spread in Italy. But Italy at the moment seems to be pretty bulletproof here. And as you can see, the Italian spread over the German bunds here are still at a very healthy levels, very nice levels for the Italians. So let's keep an eye on that. But that's probably more of a story for Monday, Tuesday of next week. Okay, so let's just look at some of the markets here. The volatility is down. VIX still trading off its lows. It's no longer in the 14 and the 15 handle, but still trading pretty much at quite attractive levels. Sorry, just having a little tea break there. We can also see, if we look at bond volatility, now that's interesting, because bond volatility is pushing a little bit higher. And historically, when the bond volatility pushes higher, VIX is not far behind. So that's quite an interesting one to see if this 2-day movement in the volatility of bonds is will start to cause a bit of pressure in VIX, which of course might start pressuring the equities themselves. So that's interesting, and that's just because a lot of the sort of the long end of the curve is moving quite a lot. So that's indicating that the cost of the volatility here of bonds is moving higher, which could it's indicating that maybe the market is starting to sort of getting a little bit worried about all of the data coming up and just generally what's happening. So that's something interesting to look at. And I'll be curious today to see if there's a spillover into the VIX itself. Now, if we actually look at equities, trading still very well. There's no technical damage done. As you can see here, hugging the 20-day exponential moving average. All of these moving averages are still pointing heavenwards up towards the skies. So no problems there. We had yesterday a pretty strong move up in Google Alphabet on the back of that sort of legal victory that they don't have to divest themselves of the Chrome server and whatnot. Although, again, the breadth is quite low. There's only a few companies who are really performing well. So it's going to be interesting to see just how long this holds up for. If we look as well at the equal weight, which is RSP ETF. You can see it's not quite as strong. So it's interesting. Look at the RSP, which is the equal weight ETF for the S&P 500. You see that over the last couple of trading sessions, that's come down. And if we go back and compare that to the ES itself, it's a lot stronger, the ES. So overall, the breadth is narrowing somewhat. The ES is being held up by some of the, obviously the big tech stocks. If we go and have a look at NASDAQ, not quite as strong either. So, there are some little sort of cracks here. Again, still no big technical damage here. ES is holding up a little bit better than NASDAQ. And NASDAQ, as I said, is being held up by, two or three of the outperformers, the really big boys. And so if they show any signs of cracking, the Nvidias of the world or the Googles or the Alphabets, this could come down. But we'll see. Again, we're going to have data over the next few days. That's probably going to be the determinant of that. Finally, again, just talking about the bonds. Like if you look at the 2-year here, this is on the December contract, pretty strong on the jolts, the weakish jolts number yesterday. Again, this is going to be a function, no doubt, of the data we get, this morning and tomorrow. And I think it is a little bit asymmetric in the sense that, the market is very much, as I said before, pricing in a cut. I think in order for, let's say, the 2-year bond to come down significantly, would have to get a very, very hot numbers for all of the data. And if it's a cold number showing any kind of economic weakness in the labor market, I think for sure it's possible that the ZT, the 2-year Treasury, rips a lot higher there. And with that, probably the 5-year as well, the ZF. Maybe not so much at the long end of the curve, or the long end of the curve is lagging a bit, but has had a couple of good days. But ultimately, something like the 30-year, this is the ZB here. It's not going to be as powerful a move as the front end of the curve, because there's still worries, as I say, about sort of lack of Fed independence, sticky inflation, lack of fiscal discipline, and also pressures coming from other bond markets around the world. For example, the Japanese 30-year yields up, the British 30-year yields are sort of trading along their highs. And so the point is that there is a little bit of contagion into the long end of the US curve coming from, places like Japan and the UK as well. So let's keep an eye on that. That's about it. Just finally have a quick look at the dollar here. The dollar, again, in a pretty tight range. I mean, it's going up and down a little bit all day. Some people are saying it's flattening out, but what we're basically seeing here is that it's hugging the 20 and the 50-day moving averages, which are going sideways. I think at this point, it's really looking for the data. If the data weakens, and it does seem the Fed will be, relatively quick and relatively aggressive with rate cuts. And there is, that lack of, potential more fiscal lack of discipline and sticky inflation, and a lack of Fed independence, political independence. These are all, good sort of fundamental reasons over the medium term for the dollar to go weaker. So if that's kicked off by weaker economic data, for sure, I think the US dollar can test down towards the 97, 96.5 levels. Talking about Fed independence, we do have, I think, the first Senate hearings today for Stephen Miran. And you remember he is Trump's nominee to take over Adriano Kugler's position on the Fed. So Stephen Miran is very much sort of the intellectual architect of a lot of Trump's thoughts about tariffs and the dollar. And actually, Stephen Miran does want a weaker dollar. And he very much believes that tariffs is a winnable kind of war. Anyway, the point is that so that test to me will be interesting in and of itself today. But if we presume that he's going to be nominated, he could take his place on the Fed board before the meeting in September, or later on this month in September. So definitely that sort of politicization of the Fed is that process is starting today. I'm not sure what time the hearings are on. I'll check that, but that's definitely something worthwhile to hear about and to listen to his views there. Okay, guys, I'll leave it there because I want to focus on ADP coming up. Have a great day, and we shall keep this conversation going tomorrow. Thank you.